Hey everyone, have you ever wondered why when you deposit $10,000 into a bank, they can somehow lend out $100,000 to 10 different people? Listen up. Today I'm going to expose a truth that 99% of Americans have no idea about, a secret that banks and the financial elite never want you to understand. This is the fractional reserve banking system, or what I call the art of creating money from thin air. You think banks lend you money from where? From other depositors? Completely wrong. The truth is they create money from nothing, from lines of code on computers, from thin air. Imagine you're playing Monopoly and you get to be the banker. Every time someone wants to borrow money, instead of giving them cash from the bank's vault, you just write a piece of paper saying, "I owe you $1 million. And just like that, $1 million has been created from nothing. That's exactly how the banking system works. Don't you see something seriously wrong here? In 2008, when the global financial crisis erupted, the whole world finally woke up. But actually, that crisis wasn't an accident. It was the inevitable result of the fractional reserve banking system. After watching this video, you'll understand why banks always win while you always lose, why inflation is a hidden tax hitting your wallet, how to recognize when you should deposit money and when you should withdraw it, and most importantly, how to protect your assets from this magic trick. I'm going to tell you straight up things that economic schools don't teach, things that books and newspapers don't write about. Brace yourself, because after this video, you'll never look at banks the same way again. Listen, forget everything you've ever thought about banks. The fractional reserve banking system isn't how banks manage your money. It's how they control the entire economy. What does fractional reserve mean? Fractional means a part. Reserve means what's kept back. So banks only need to keep a small portion of the money you deposit. And what can they do with the rest? Lend it out. In the United States currently, the reserve requirement is around 10% for demand deposits. This means when you deposit $10,000 into a bank, they only need to keep $1,000 and the other $9,000, they lend it to someone else. But this isn't even the most magical part. Now I'll show you how banks turn your $10,000 into $100,000 in the system through the money multiplier effect. First step, you deposit $10,000 into Bank A. Bank A keeps $1,000 and lends $9,000 to John. Second step, John takes that $9,000 and deposits it into Bank B. Bank B keeps $900 and lends $8,100 to Sarah. Third step, Sarah takes that $8,100 and deposits it into Bank C. Bank C keeps $810 and lends $7,290 to Michael. This continues, and you know what the final result is? From your original $10,000, the banking system has created $100,000. Simple math formula. $10,000 divided by 0.10 equals $100,000. This is the money multiplier effect. But here's the most important question. Who owns that extra $90,000? Answer, the banks. They've just created money from nothing while collecting interest on money that doesn't exist. Why is this legalized fraud? Think about it. You deposit money in a bank believing that money can always be withdrawn when needed. But in reality, 90% of that money is no longer in the bank. The bank has lent it to someone else. So what happens if all customers come to withdraw money at the same time? Bank run. The bank goes bankrupt immediately. That's why in 2008, when rumors about financial difficulties at some banks spread, thousands of people lined up to withdraw money. Not because banks actually ran out of money, but because this system was fundamentally a scam from the start. But that's not all. The most terrifying part is still coming. Have you ever wondered why the economy sometimes booms and sometimes busts, and why these crises appear as regularly as a natural cycle? I'll tell you straight. This isn't natural. This is intentional. The Federal Reserve is the director of this entire play, and their main tool, interest rates. The first phase is pumping money to create bubbles. The script. The Federal Reserve announces cutting interest rates to extremely low levels. Immediate results. Borrowing costs drop dramatically. Businesses rush to borrow for expansion. People borrow to buy houses and cars and invest in stocks. Money flows freely throughout the economy. Why do they do this? Because at this point, With low reserve requirements, every dollar pumped into the system gets multiplied by 10 times through the money multiplier effect. From 2009 to 2015, the Fed cut interest rates to near 0%. The result? The U.S. real estate market went crazy. Stocks hit record highs. During this period, lending rates dropped from 6 to 8% down to 3 to 4%. Real estate prices in cities like San Francisco and New York increased 40 to 60% in just a few years. But this was just the beginning of the plan. The second phase is withdrawing money to burst the bubble. When everyone is drunk on investment fever, when everyone has borrowed up to their necks to join the game, the Federal Reserve suddenly reverses course. The script: dramatically raise interest rates under the pretext of fighting inflation. Immediate results: borrowing costs skyrocket, businesses can't pay their debts, people can't make their house and car payments, real estate and stock markets collapse. Who benefits from this crisis? The banks themselves. They seize collateral assets at bargain prices. A house worth $500,000 during the boom, they can now buy back for $200,000 to $300,000 from people who can't pay their debts. A concrete example of the 2008 crisis: before 2008, mortgage rates in the U.S. were 3 to 4% per year. Banks lent 100% of home value, even 110%. People earning $3,000 per month were approved for $500,000 home loans. Everyone believed house prices never go down. After 2008, interest rates jumped to 7 to 8% per year. Millions of Americans lost their homes. Major banks harvested hundreds of thousands of properties. The same pattern happened during other periods. From 2006-2007, lending rates of 5 to 6%. Everyone rushed to buy houses. From 2008 to 2009, rates jumped to 8 to 10%. Thousands of people couldn't pay their debts, sold houses at losses. And this cycle repeats forever. The lesson: whoever creates the rules always wins. Banks aren't just places to store money. They're the architects of the entire economic system. By controlling the money supply through interest rates and reserve requirements, they can create artificial prosperity, cause crises at will, acquire assets at rock-bottom prices, enrich themselves from others' suffering. And you're just a pawn in their game. This is exactly the question many of you are wondering about. If the fractional reserve banking system really has these problems, why hasn't it collapsed? Why don't governments stop it? The answer will completely enlighten you. The first reason is government collusion. The truth is, government and banks are allies, not enemies. When the government needs money for spending like building infrastructure, paying civil servants, funding healthcare and education, they don't raise taxes because people would protest. Instead, they issue government bonds. Who buys these bonds? Banks. And where do banks get the money to buy them? From thin air. They just type on a computer, create numbers, and lend to the government. Result: government gets money to spend, banks get more assets and collect interest. Who pays the price? The people through inflation. The second reason is deposit insurance systems. To prevent people from fearing bank runs, governments created deposit insurance systems. In the U.S., FDIC protects up to $250,000 per person per bank. Sounds safe? Not at all. Where does the insurance money come from? From the government budget. That means from your taxes. This means when banks go bankrupt from reckless investments, you still have to pay to rescue them through taxes and inflation. The third reason is too big to fail. In 2008, when major U.S. banks were about to go bankrupt, the government rescued them with $700 billion from the budget. The reason? They're too big to fail. If we let them collapse, the entire system will collapse. But this is the biggest trap. By allowing banks to become too big to fail, the system created a situation where profits belong to banks, risks belong to the people. The fourth reason is censored financial education. Have you ever wondered why schools don't teach how money really works? Because if everyone understood this system, they would stop depositing money in banks, stop borrowing unnecessarily, find ways to protect assets from inflation, demand a more transparent system. And that's exactly what they don't want. Bank runs are the Achilles heel of the fractional reserve banking system. Why are bank runs so dangerous? Remember, banks only keep 10% of deposits. 90% has been lent out. If just 15% of customers come to withdraw money simultaneously, the bank runs out of cash immediately. Historical bank runs like 1929 during the Great Depression. In 3 years, 9,000 U.S. banks went bankrupt, $86 billion in deposits vanished, millions of people lost everything. In 2008, during the subprime crisis, Northern Rock in the UK collapsed after customers withdrew $13 billion in 3 days. Lehman Brothers went bankrupt, dragging down numerous other banks. The world lost $11.9 trillion in assets. In the U.S., we've seen examples like Washington Mutual in 2008, Silicon Valley Bank in 2023, where thousands of depositors struggled to get their money back. How the system prevents bank runs includes the first method of limiting withdrawals: daily withdrawal limits. ATMs only allow $500 to $1,000 per day, requiring advance notice for large withdrawals, encouraging electronic transfers instead of cash. The second method is media confidence building. Banks are very safe. Deposits are 100% insured. These are just false rumors. The third method is Federal Reserve intervention, emergency money injection, bailouts, ensuring liquidity, nationalization if necessary. The fourth method is moving to digital currency. This is the newest trick. When everything is just numbers on computers, creating money and control becomes easier than ever. CBDCs aren't for your convenience, but to completely control all your transactions. After hearing all this, you might feel shocked, even angry. That's a normal reaction. But most importantly, what will you do with this knowledge? Things you can do today. First, don't save too much in banks. Only deposit money needed for monthly payments. Large amounts should be moved to real assets like gold, real estate, valuable stocks. Second, understand economic cycles. When interest rates are low, be wary of asset bubbles. When interest rates are high, this is an opportunity to buy assets cheap. Follow Federal Reserve policies. Third, learn about inflation-resistant assets. Gold is a traditional 5,000-year asset. Bitcoin is the digital gold of the 21st century. Real estate is a real asset hard to dilute. Good company stocks rise with inflation. Fourth, continuously educate yourself. Read books about personal finance. Understand how the monetary system really works. Don't trust free advice from banks. The fractional reserve banking system isn't evil. It's just a tool. The problem lies in who's controlling this tool and for what purpose. When you understand the rules of the game, you can protect your assets, take advantage of economic cycles, avoid being fooled by financial tricks, create reasonable long-term financial plans. Remember, in this game, knowledge is power. If this video was useful to you, please like and share to help wake up more people. Subscribe to the channel so you don't miss other deep analyses of the financial system. See you in the next video, where I'll reveal the Bitcoin conspiracy, why central banks fear cryptocurrency. Thanks for watching.